Buffett bought 12 million something shares of Capital One today. Capital One is down from 124 to 89. It was up to 94 after hours. Let's start with Carlos first on this. Why do you think Buffett's buying Capital One?
I think he does this every year. I think this is the annual rotation into value.
Yeah, like every 50 years he buys banks. I mean,
not every 50.
No.
He's
every year he buys banks. Okay.
Yeah, I just don't think it's a big deal. I think to Chris's point about the extreme fear, I think every single thing is overanalyzed, and everyone's just trying to get ahead of this rug pull, a market pull. But I don't think in a normal environment that this would be news. And I do think, like I said, I figured like around May 12th, that's when I feel like we're going into the sell in May, and now we're going to see the money rotate out of the growth stocks and start going into the value plays where money's going to be relatively safe for the next couple of months. Look, what is it? Memorial Day is next weekend.
It is?
Yeah, and then the week after Labor Day, what happens? The market rally. Like
Labor Day's in September, though, right?
End of what is it? Like end of
August.
The first week of September. So yeah, whatever. That's the official end of summer. I just don't think it's much more than that, to be honest.
Okay, Chris, are you reading into Buffett buying the banks, or is it not a big deal, as Carlos says? You're muted.
Yeah, let me just show you really quickly the exact equation that he uses to value this right now. Okay, so let me just share that over.
Is it using an advocate?
No. You see this right here. This is just the PE ratio. Most banks, they pretty regularly trade. I mean, there'll always, of course, be like years where there's huge overperformance or underperformance, blah blah blah. But if you look at it, most banks, they usually trade at about a 10 to 12 PE, right? So when you have a bank drop to a PE of almost like 5,
wow,
that means that there is a huge amount of upside that's going to be built in. All it needs is just to do mean reversion, right? So if you look at a lot
what
of
is mean
banks,
reversion? Can you explain that?
So basically it goes right back to being in the middle again, right? So if you have like this steady state of being, right, like Alex Karp would say,
the ontology.
And then he's saying if it trades at a 12 and it's now at a 5, it's going to go back to a 12.
I know what mean reversion means. I thought you could explain it in a more nuanced way. That's it. I get it. Obviously, logically, you could put mean reversion together.
So there's a lot of banks right now that are trading way below PE levels. Even if you look at it on a price to book perspective, to book.
Can we explain that one? Can we explain those two? Vitaly, I'm gonna start with you. What exactly is price to earnings for those? There's someone in this 349 people that are here. By the way, shout out to 300 again. Let me ring the little bell.
The damn bell.
Thank you, everybody. 9th night in a row for 300. What exactly is price to earnings, and why is it a metric that investors really need to care about? Because tech stocks are like a 30 PE, but then Chris is talking about banks are average at a 10 PE. So why do we give Tesla a 50 PE? And we willingly pay that as investors, but for banks, we're not willing to pay more than 10 or 12 PE.
Well, obviously, companies have a certain revenue, and then they trade at a certain market cap. So once you figure out, once you get the PE of that kind of, you do once you figure out the market cap versus the earnings that they actually make, then you get the PE. And if it trades too high, then people are paying for their earnings for, let's say, a PE of 50 means like you're paying 50 times earnings, right? So if you want to do that as a growth investor, that might make sense for Tesla because Tesla's growing at a 50% compounded, right? But if SoFi is not growing, or let me bring up a bank. If a bank is growing at 2%, 5%, right? You wouldn't want to pay that much. You wouldn't want to pay a 50 PE. You would want to pay a 6 PE, a 10 PE, a 12 PE, whatever. So hopefully that makes some sense.
Okay. Every industry has different PEs that they trade at historically. Okay. So just like Vitaly said, you have tech companies, high cash flow. They're able to reinvest the money, write it back into their business, keep growing. So if you're looking at a growth stock, growth usually, you're going to get a higher PE. So the measure that you would use is PEG, so price to equity to growth. So basically, if you're growing really fast, you want to compare against other companies that are growing fast also. When it comes to value companies and sectors that are traditionally value-based, that's where you use your regular PE metric. So from a PE metric, banks are good, like a good way to measure a bank is a PE ratio. The other, of course, is the price to book ratio, which is another big one. And that one is very simple. Price to book is what is the value of your assets minus what is the value of your liabilities, right? And then based on that, you get a number, and then you look at the market cap. And if your market cap is way below, what is that thing called? way below your book value, that means that you are undervalued. So you have a negative price. I'm not negative, but you have like less than 1 price to book, because technically your market cap and your book value should theoretically be the same, right? Your assets and liabilities, I mean, when you subtract them out, 1 should equal to 1. But there are times in the market where Mr. Market gets stupid and is willing to sell shit at a discount because they're afraid something might happen.
I don't think I've ever seen a 1-to-1 price to book.
What? No, there's tons of
for
companies
banks.
that are priced.
Is it for banks?
Yeah. Banks are traditionally trade at 1. Believe it or not, even sometimes a premium of a little bit. Like
I guess following growth, I've never seen that. Like right now,
Yeah.
what does Tesla trade at price to book? I don't even know.
So that's the key right there, because there are so many intangible assets that growth
For a
companies have,
company like Tesla,
like not just Tesla, but think about Google, right? If you took it on an assets to liabilities basis, Google has so many intangible assets that they're not going to accurately reflect a book value, because there's nothing that you can actually like subjectively put towards
What's an
it. Like,
example of an intangible asset?
Well, I'm looking at price to book for Google. It's 5.
Yeah, but that's because it's a tech company, right? Tech companies, it's really hard to value. Like, okay, if I told you right now, what is the value of Google's search business? You know, there's a certain multiple that you can come up with, but it's all pie in the sky. Whereas I can tell you how much is a dollar worth in JP Morgan's bank account. It's worth $1.
Or like,
and the reason you're saying this is because a dollar in JPM's bank account, we can pretty much know what they're going to do with that dollar to generate a return.
It's liquid. It's liquid.
With Google's
JPM
business, even if we JPM.
Sorry, I was going to say price to book JPM right now, 1.43.
Yeah.
1.43. Okay. So Google's ad business, let's say they did 70 billion in revenue. The reason you're saying we can't put a valuation on that is because we don't know what the future growth looks like. We don't know how
what
much
the value. It's hard to value their assets because
like an intangible asset is not valued like real estate. Like ExxonMobil, if they go out of business tomorrow, you can calculate what the land that they own is worth. For the
but here's my question: Why isn't search a tangible asset? Because it's still worth 70 billion of revenue.
But you can't touch it. It's not a physical thing.
You can't touch it.
And it's not a physical thing in the world.
Okay, so here's the perfect example that I'll give you, Amit. Okay, I have RC Cola and I have Coca-Cola. Let's say they're 2 different types of things, right? But they're both the same thing. What is the intangible asset of Coca-Cola? Like, what is the brand of Coca-Cola actually worth versus RC Cola? Because essentially they're just 2 Coca-Colas, right?
Well, what did you take the revenue from the Coca-Cola company and attribute it to the brand?
That's not how it works. No, it's hard to value that because RC Cola can have its own little thing. Coca-Cola could be worth a whole different thing. So like right now, when you go to a grocery store, why does no one pick up RC Cola and why does everyone buy Coca-Cola? Right? Because there's an intangible.
Bud Light. I saw a guy buying it today. And he was ashamed. He was ashamed of buying it. It was sad.
Oh my gosh.
Anyway,
it's funny you mention that because I'm looking up these companies at the same time. Price to book for Coke is 5.
Yeah, because once again, intangibles, right? It's really hard.
Price to book for Enphase is 28.8.
Once again,
seems a little pricey for microinverters.
It's very pricey. I agree.
Real estate should be usually priced.
Actually, 31. It's 31.
Yeah, real estate should be usually price to book is usually flat, like 1 or 2, right? Banks, same thing. Other industries, not so much. Like an example, another one is like Universal Music Group, right? Like UMG. Like how would you value the masters of
Drake's music, right? It's hard.
Drake's music. It's hard, you know.
So you're saying if a bank trades below its price to book, it's stupidly undervalued because we can tangibly measure what the price to book should be.
Yes.
Because it's not a growth company outside of SoFi, right?
Yeah. Yeah, because you're just taking assets, you're subtracting liabilities, and you're getting a good figure. That's it. I mean, there are little carve outs here and there for like goodwill. Like, do you know what goodwill is?
Yeah. Yep.
Yeah. There's a little carve out for goodwill stuff. And then there's, of course, depreciation. And like there's little things, but nothing that's going to like be a huge impact on the price to book. So with regards to banks, you typically want to look for things that are under 1. If they're pretty much flat, and the further they are from 1 in terms of like below, that means they're more likely to be
below its price.
I hate to ask, but what's a TFC? Truist.
TFC price to book.
Truist.
It's below 1. It's like 0.5 or something, right?
0.6, I think. Last time I checked.
0.62 or something like that.
Mm-hmm.
Yeah.
Well,
TFC is undervalued. If that's your
SoFi is 0.98.
It's below 1.
Yeah.
Well, that's why Tanner said it's 1-to-1 almost.
Yeah. So
Okay.
for TFC, the book value is 0.65.
Oh, thank you, Andrew, for posting that. We got a bunch of them right
Yeah.
there. JPM 1.31. So you're saying for a bank, it should be 1 or slightly above for a bank,
Or slightly below, or
or
slightly
slightly
below.
below.
Yeah.
TFC
If you're not growing so much, it should be slightly below. If you're growing a little bit more and you're more safer, then maybe a little bit. Like JP Morgan, of course, is safer, so they deserve a little bit of an extra valuation, right? They're a systemically important bank. Other ones are not. So of course, the book value of JP Morgan is going to be a little bit higher. Same thing with like a level of PE that you're more willing to accept with JP Morgan, right? So that's the
So you're
key.
saying
So
Buffett's buying these banks because they're below 1 on the price to the PE, sorry, is also below 10, where it's historically supposed to be. Price to book is also below 1, or even less than 0.5 in some of these cases. And so that's why Buffett's but Vitaly and Carlos's point is Buffett's always been buying banks. So is it that unique that he's buying because he's always been doing it?
I mean, it's
You know
the
what, you know
easiest
what it sounds like
investment.
to me? You know what it sounds like to me? It sounds like to me right after COVID happened, and he was one of the first to buy. What did he buy? Delta.
No,
Did
he
he?
sold Delta. He
sold
sold
Delta,
the
yeah.
airlines.
No, but he started buying some of the airlines. It was
Oh, he
after.
sold the airlines.
Yeah, no, he
Okay.
started buying. Remember, there was a whole press conference for it.
He
And
was buying
talking-
something. I don't know if he
And
was buying
it was
airlines.
it was specifically an airline when they were talking about people are not going to fly. They're going to have one person per 3 seat. All that stuff. And he had a whole press conference about it, talking about how you got to support these businesses and whatnot. Like,
He sold 13 million shares of Delta on April 3rd, 2020. But you're right, Carlos. He bought something. I don't
May
know what.
2nd,
it might have
2020.
been. It might have been
Warren
American.
Buffett says Berkshire sold all its airline stocks because
Yeah,
of the coronavirus.
you got the headline wrong, but you're right. He did buy something. I'm forgetting. I think he bought.
He did. He bought
I
something.
might be throwing this out there. I think he bought Pfizer. I might be totally wrong on this.
Oh,
I feel like he bought either a drug or he bought what's the other thing he bought?
So Amit, before you go into put this comment on the thing, because I think it's very important, and that's the exact equation that's in my brain as well. The one from Eric. So he put more risk, like personal loans, means liquidating your books usually occurs at a discount in the event of bankruptcy. So riskier banks trade at below price to book of 1, offset by growth. SoFi right now has a shit ton of personal loans, which are not backed by any assets. With other things, other loans, they're actually backed by assets that the bank can take over and use to liquidate. Personal loans are unsecured liabilities. So that means that if, let's say, tomorrow morning there's an issue with creditors not paying, debtors not paying their money, and you have to sell that liability to somebody else, you're not going to get $1 for it. You're going to get 50 cents on the dollar, maybe even 20 cents on the dollar, which means it proposes a much higher risk. So even though if you look at SoFi and you look at price to book ratios, like, oh, it's almost 1-to-1. When you really take a deep dive into, okay, these personal loans, how much are they actually worth on the open market? They could be materially different and actually be at a significant discount to what it is. So just because the price to book on a balance sheet, like from a balance sheet perspective, looks attractive, you have to deep dive and understand that, hey, the asset itself may not be worth it. SLG, and I'm glad someone brought it up there, SLG is in the same boat. Yes, they have assets on their books that they have, like, oh, this building is worth, $2 billion or $3 billion, whatever. But if you go on the open market and try to sell it right now, you're not going to get 2 billion, 3 billion for it. You might get 1 because the market is bad, right? Maybe when the market recovers, the book value of that asset will go back up again. But depending on how the market is for the asset yourself that you have, there's vastly different calculations that you have to plug in your head, So, yeah.